Have you ever wondered why your coffee suddenly costs $5 instead of $3? Or why your parents talk about buying their first house for what seems like pocket change today? Here's what nobody tells you. These aren't random events. They're not just inflation doing its thing. They're the direct result of decisions made by a small group of people in a building you've probably never visited. Here at Simple Money, we've spent years breaking down complex financial topics for everyday people. And today, I'm going to reveal why monetary policy, something that sounds incredibly boring and technical, is actually the invisible force shaping your entire financial life. By the end of this, you'll understand how these decisions affect everything from your job prospects to your ability to buy a home. And more importantly, you'll know what to watch for. Here's what's really happening. Most people think the economy just kind of happens, like weather. Sometimes it's good, sometimes it's bad. You just deal with it. But that's not how it works at all. Every single day, a group of economists at the Federal Reserve, which is basically America's central bank, is pulling levers that change the rules of the game for everyone. They're adjusting interest rates. They're buying or selling massive amounts of government bonds. They're essentially controlling how much money flows through the economy. And here's the kicker. These decisions don't just affect Wall Street bankers or Fortune 500 companies. They affect whether you can afford rent next year, whether your job still exists in 6 months, whether that retirement account your parents have been building for 30 years will actually be worth anything. Think about it this way. Imagine the economy is a massive bathtub. The Federal Reserve controls the faucet and the drain. They decide how much water, which represents money, flows into the tub. They decide how fast it drains out. Too much water? The tub overflows. That's inflation. Your money becomes less valuable because there's too much of it floating around. Too little water? The tub runs dry. That's recession. Businesses can't get loans. People lose jobs. The whole system seizes up. The Fed's job is to keep the water level just right. Not too hot, not too cold, just perfectly balanced. But here's where it gets complicated. And this is what most people completely miss. The Fed doesn't just affect big abstract things like inflation rates or GDP growth. They directly impact the most personal financial decisions you'll ever make. Let me show you exactly how. The first way monetary policy hits your wallet is what I call the borrowing tax. Here's what this means. When the Federal Reserve raises interest rates, they're making it more expensive to borrow money. Any money, everywhere. Your credit card rate goes up. Your car loan gets more expensive. That mortgage you were thinking about just became significantly pricier. And this isn't some small difference we're talking about. Let's get specific with real numbers. In 2020, you could get a mortgage with an interest rate around 3%. By 2023, that same mortgage was closer to 7%. On a $300,000 home loan, that difference means you're paying about $1,500 more every single month. That's $18,000 more per year. Over 30 years? We're talking about hundreds of thousands of dollars in extra interest. Same house, same you, different monetary policy. Now here's the psychology behind why this matters so much. Most people don't think about interest rates when times are good. They just see the monthly payment and figure out if they can afford it. But the Fed's decisions are determining what affordable even means. They're literally deciding how much of your future income gets siphoned off to pay interest instead of building wealth. The people who understand this don't just look at monthly payments. They pay attention to interest rate trends. They time their big purchases strategically. They refinance when rates drop. The people who don't understand this just accept whatever rate they're offered and wonder why building wealth feels impossible. The second impact is what I call the job security shuffle. When the Fed raises interest rates to fight inflation, they're intentionally trying to slow down the economy. That's not a side effect. That's the goal. And you know what happens when the economy slows down? Companies stop hiring. They start cutting costs. They lay people off. This might sound harsh, but it's true. The Federal Reserve will sacrifice job security to keep inflation under control. They've openly said this. They call it the sacrifice ratio. How many jobs need to be lost to bring down inflation by 1%? Think about what this means for you personally. Your job security isn't just about how hard you work or how valuable you are to your company. It's also about whether the Federal Reserve thinks the economy needs cooling down. During periods of tight monetary policy, which means high interest rates, unemployment goes up. Always. It's not a coincidence. It's the mechanism. Here's the uncomfortable truth. When you hear about the Fed raising rates, they're essentially betting that some people losing their jobs is worth it to keep prices stable for everyone else. Now, I'm not saying this is wrong. Unchecked inflation can destroy an economy. But you need to understand that these trade-offs exist. Your job, your raise, your bonus, they're all influenced by decisions made in boardrooms you'll never enter. The people who succeed during these cycles understand something crucial. They build what I call recession-proof skills. They create multiple income streams. They save more aggressively when times are good because they know the shuffle is coming. The third way this affects you is the invisible wealth transfer. This one is particularly sneaky because most people never see it happening. Here's how it works. When the Federal Reserve keeps interest rates really low for a long time, they make borrowing cheap. Which sounds great, right? But there's a hidden cost. Low interest rates punish savers and reward borrowers. Specifically, they reward people who already own assets. Let me break this down with a real example. Imagine you've saved $10,000. You're proud of yourself. You're being responsible. You put it in a savings account. In 2010, you might have earned 3 to 4% interest on that money. Not amazing, but something. Your $10,000 would earn you $300 to $400 a year just for sitting there. Fast forward to 2020. Interest rates are near zero. Your $10,000 earns you maybe $10 a year. Maybe. Meanwhile, someone who already owns a house just saw their property value skyrocket. Why? Because low interest rates made mortgages cheap. More people could afford to buy. Demand went up, prices followed. So the person with assets got richer. The person saving cash got poorer in real terms because inflation ate away their purchasing power faster than they could earn interest. This is the invisible wealth transfer. Monetary policy shifted wealth from people trying to save money to people who already owned property and stocks. Our brains aren't wired to see this happening. We see our account balance staying the same and think we're fine. We don't realize that every dollar we saved last year buys less stuff this year. And here's what makes this even more insidious. This transfer happens slowly, month by month, year by year. By the time you notice, you've already fallen behind. The fourth impact is what I call the retirement mirage. Your parents probably told you to save for retirement. Put money in a 401k. Let it grow for 40 years. You'll be set. That advice made perfect sense in their world. But monetary policy has completely changed the game. Here's why. Traditional retirement planning assumes that bonds, which are basically loans you give to the government or corporations, will provide steady, safe returns. Historically, you could get 5 or 6% on a government bond with basically zero risk. That math worked beautifully. You could retire on a nest egg because that nest egg kept producing reliable income. But after decades of the Fed keeping rates low, bonds pay almost nothing. And when rates suddenly spike up, existing bonds lose value. Fast. People who retired in 2022 got absolutely hammered. Their bond portfolios, the safe part of their retirement, dropped by 10 to 20%. At the exact moment they needed that money. This wasn't because they made bad decisions. It was because monetary policy changed the rules on them. Think about what this means for your retirement planning. You can't just follow the old playbook. You need to understand that the Federal Reserve's decisions today are shaping what your retirement will look like in 30 or 40 years. Low rates for too long mean your savings don't grow. High rates mean your existing investments can lose value. There's no safe harbor anymore. The psychology here is brutal. We want to believe that if we just follow the rules and save consistently, we'll be okay. But monetary policy is constantly shifting what okay even looks like. The people who are successfully navigating this aren't just saving blindly. They're adjusting their strategy based on the monetary policy environment. They're diversifying in ways their parents never had to. The fifth and final way monetary policy affects you is the opportunity window. This is actually the most empowering insight of all, once you understand it. Every monetary policy cycle creates specific opportunities and specific dangers. The key is knowing which window you're in. When interest rates are low, it's a borrowing window. This is when you take out that mortgage, refinance your student loans, start that business that needs startup capital. When interest rates are high, it's a saving window. This is when you lock in those high-yield savings accounts. Buy bonds. Let your cash actually work for you. Most people do the opposite. They borrow when rates are high because they need money right then. They spend when rates are low because money feels cheap. Here's a real scenario. Meet Jake. Jake graduated college in 2021. He had about $30,000 in student loans at 4% interest. Interest rates were low. Everyone was telling him that rates would probably stay low forever. So Jake focused on investing. He put extra money into crypto and stocks instead of paying down his loans. Then 2022 happened. The Fed started raising rates aggressively. Jake's investment portfolio dropped 30%. His student loan rate stayed at 4%, but now that 4% looked like a great deal compared to current rates. If Jake had understood monetary policy cycles, he would have refinanced his loans to an even lower rate when he had the chance. He would have known that ultra-low rates don't last forever. Now let's talk about Sarah. Sarah graduated the same year as Jake. Similar loan balance, similar interest rate, but Sarah had been following monetary policy news. Not obsessively, just enough to understand the basics. She saw that rates were historically low. She refinanced her loans to 2.5%. Then she paid off her highest rate debt first, which was her credit card. When rates started climbing in 2022, Sarah was protected. Her loans were locked in at 2.5%. She had no high-interest debt. She actually started putting money into high-yield savings accounts that were suddenly paying 4 or 5%. Same starting point as Jake, completely different outcome. The difference wasn't luck, it wasn't intelligence. It was understanding which opportunity window she was in. Here's what most people don't realize. The opportunity window insight completely reframes how you should think about financial decisions. You shouldn't make big financial moves just because you feel ready or because it's the right age to do something. You should make them based on whether the current monetary policy environment makes that move advantageous or dangerous. Buying a house isn't just about whether you found the right place. It's about whether mortgage rates make that purchase wise right now. Starting a business isn't just about having a good idea. It's about whether you can access affordable capital in the current environment. Investing aggressively isn't just about your risk tolerance. It's about whether asset prices are inflated by years of easy money or depressed by tight policy. The people who build real wealth aren't just working harder or getting luckier. They're making big moves during the right monetary policy windows and staying cautious during the wrong ones. But here's what nobody wants to admit. Understanding this doesn't just help you make better decisions. It reveals something uncomfortable about how the system actually works. The financial system isn't a level playing field. It never has been. The people who understand monetary policy get richer. The people who don't get left behind. And it's not because they're smarter or more deserving. It's because they have information that most people don't even know matters. When the Federal Reserve announces they're changing rates, wealthy people call their financial advisors. They restructure their debt. They rebalance their portfolios. They move their money to wherever the new policy makes it grow faster. Meanwhile, most people just keep doing what they were doing. They don't even know that the rules just changed. This is why financial literacy matters so much. Not the boring kind where you learn to balance a checkbook. The real kind where you understand how the system actually works and who's pulling the levers. Think about it this way. Every single monetary policy decision creates winners and losers. The winners are the people who saw it coming and positioned themselves accordingly. The losers are everyone else. You can't opt out of this system. You're in it whether you understand it or not. The only choice is whether you're playing the game consciously or just getting played. Let me bring this all together. The borrowing tax means your purchasing power for homes and cars and education gets determined by people you never elected. The job security shuffle means your employment stability depends partly on what the Fed thinks about inflation. The invisible wealth transfer shifts money from savers to asset owners whenever rates stay low for too long. The retirement mirage means you can't just follow your parents' playbook anymore. And the opportunity window means timing your big financial moves around policy cycles matters more than most people think. These aren't character flaws. They're not evidence that you're bad with money. They're predictable patterns that happen to everyone who doesn't understand how monetary policy works. But here's the empowering part. Once you see these patterns, you can't unsee them. And once you understand them, you can start making decisions differently. You don't need to become an economics expert. You don't need to read Federal Reserve meeting minutes. You just need to pay attention to the basics. Are interest rates going up or down? Is the Fed worried about inflation or recession? Are we in a borrowing window or a saving window? Those 3 questions will tell you almost everything you need to know to make better financial decisions than 90% of people. The question isn't whether monetary policy will affect your life. It already does. Every single day. The question is whether you'll understand it enough to use it to your advantage instead of being used by it. Because the people who succeed financially in the long run aren't the ones who make the most money. They're the ones who understand that money itself keeps changing value. And they position themselves accordingly. What window are you in right now? And more importantly, what are you going to do about it?